Do you know how institutions use dark pools, algorithms, and fake breakouts to trap retail traders like you? Or have you ever wondered why your trade hits a stop loss right before the stock explodes in the other direction? What if I told you that smart money is front-running your orders, manipulating options, and even controlling the financial news you trust? In this video, we're breaking down the top 10 shocking strategies smart money uses to dominate the market, from stealth accumulation to engineered liquidity traps, and showing you exactly how they move in silence while retail gets left holding the bag. If you've ever felt like the market was rigged, hit that like button, drop a comment below, and make sure you subscribe so you never trade blindly again. Number 1. They don't follow the news, they create it. Retail traders react. Smart money orchestrates. When a major investment bank releases a bullish report on a stock, most people see it as objective analysis. But behind the scenes, that report may be timed after the institution has already accumulated shares at a lower price. By releasing positive coverage, they create artificial demand and retail FOMO, allowing them to exit into strength. The same applies in reverse. If they want to short a stock or exit a long position, they may quietly feed bearish sentiment into media channels, downgrade ratings, or highlight exaggerated risks to push prices lower. These firms also have entire departments dedicated to managing their public narrative. Strategic leaks, analyst calls, and even financial journalism can be part of the puzzle. Retail investors think they're reading facts, but they're often reading the marketing plan of institutional exits or entries. Number 2. They use dark pools to hide their moves. Hey, I know everyone knows about Deadpool, the witty superhero, but have you ever heard about the dark pool? It's not quite as comedic, but it's definitely a place where some serious behind-the-scenes action happens in the stock market. Dark pools sound sinister, and they kind of are. These are private exchanges where institutions can execute enormous trades without alerting the public market. If a hedge fund wants to buy 10 million shares of a company, doing so on a normal exchange would spike the price and reveal their intent. Instead, they use dark pools to split their orders, buying in stealth mode. The average trader sees none of this because dark pool trades don't show up on level 2 data or real-time charts. This allows smart money to accumulate or dump positions without setting off alarms. By the time the trade shows up in the lit market, it's already too late. Retail traders are left trading the shadows of a move that happened hours or even days before they noticed. Number 3. They engineer liquidity traps. Ever felt like the market knew your stop loss? That's not paranoia. It's a tactic. Institutions often intentionally break key technical levels, like support or resistance, to trigger stop losses, lure in breakout traders, or force margin calls. This creates a flood of liquidity, which they use to fill their own large orders at better prices. Once filled, they reverse the move. Retail is left whipsawed, wondering what just happened. These liquidity traps aren't random price action. They're designed to exploit predictable behavior. Smart money knows exactly where retail traders play stops because they help write the books that teach them. And once those stops are triggered, they become the perfect liquidity pool to absorb with minimum resistance. Number 4. They trade based on order flow, not charts. Charts tell you where price has been. Order flow tells you where it's going. Institutional traders don't rely on double tops or RSI divergence. They use tools like level 3 data, time and sales, and footprint charts to see how orders are flowing in real time. They look for signs of aggression, absorption, spoofing, and hidden size. These metrics reveal whether buying pressure is genuine or manufactured, and where big players are positioning themselves. It's like watching a poker game where you can see your opponent's hand, while retail traders are staring at old screenshots of a table. Order flow gives institutions a forward-looking edge, letting them anticipate moves before they're reflected in price. That's why by the time retail reacts to a breakout or breakdown, smart money is already out or on the other side. Number 5. They use algorithms to exploit retail behavior. Institutions don't just use AI to trade, they use it to study you. Their algorithms are trained on billions of data points from retail platforms. They know the exact setups, breakout patterns, and risk-reward ratios retail traders use. These bots can simulate a move, like breaking out of a triangle, triggering retail entries, then immediately reverse it. This trap is called a stop-run reversal, and it's one of the most common forms of manipulation. These algorithms evolve constantly. They track Reddit sentiment, Twitter buzz, and Google Trends in real time. They monitor click rates, option flow, and retail brokerage order books. You're not just up against another trader. You're up against machine learning systems trained on your behavior. And unless you learn to think like them, you're just feeding the algorithm. Number 6, they accumulate silently using range compression. Before explosive moves, institutions often spend weeks or months preparing. They do this by compressing the price into tight ranges, often between well-defined support and resistance. During this phase, they quietly accumulate shares while keeping volatility low, so they don't attract attention. The low volatility makes retail lose interest, believing nothing's happening. But beneath the surface, smart money is absorbing every share retail is willing to sell. This boring price action is intentional. It's a stealth phase. Once they've built a full position, they ignite the breakout with heavy volume, triggering FOMO from everyone who missed it. The resulting spike is fast, aggressive, and almost always looks like it came from nowhere, but in reality, it was engineered over time. Number 7, they rotate capital across sectors to hide intentions. Smart money doesn't chase. They rotate. Institutions don't just buy tech stocks because they're hot. They rotate capital from one sector to another strategically, often to camouflage their true moves. If financials are overheated, they might start slowly exiting while simultaneously rotating into underperforming sectors like energy or utilities. This rebalancing keeps the overall market looking stable while hiding massive shifts in positioning. They also use this technique to distract attention. While media and retail focus on shiny objects like AI or biotech, institutions may already be quietly accumulating boring but undervalued sectors. By the time the headlines shift, the smart money is already up 15 to 20%, and retail is once again late to the party. Number 8, they front-run index rebalancing. Index funds like the S&P 500 have strict rules. Smart money exploits them. Before a stock is added to a major index tracking funds are forced to buy it, no matter the price. Institutions use data models to predict which stocks are likely to be included, then quietly buy them in advance. Once the announcement is made and index funds begin buying, prices spike, and that's when institutions sell into the demand. It's called index front-running, and it's not illegal, just incredibly sophisticated. They're trading against the known future behavior of passive funds, which are becoming more predictable every year. It's like knowing when the tide will rise and placing your ship perfectly to ride the wave, while everyone else wonders why the water's moving. Number 9, they exploit retail through options manipulation. Options give retail traders leverage, but institutions use them as weapons. Smart money knows that most retail traders don't understand how implied volatility, open interest, and gamma exposure affect price. So they write options that look attractive, like short-dated OTM calls, and collect the premium as those options decay. They also use options positions to pin the stock price near max pain, the level where the most options expire worthless. During high-interest events like earnings, they may buy and sell both puts and calls to create volatility and then crush it, profiting from both movement and decay. The result? Retail loses whether the stock moves or not. Behind every flashy YOLO trade, there's a desk full of quants making sure the house always wins. Number 10, they use high-frequency trading to front-run you by milliseconds. This is the part of the game that feels most unfair because it is. High-frequency trading, HFT, firms spend millions to install servers physically closer to exchanges, just to shave microseconds off their execution time. They use these speed advantages to front-run your orders, identify large flows, and arbitrage tiny inefficiencies faster than any human ever could. If you place a market order to buy 1,000 shares, an HFT bot might see it milliseconds before it's filled, buy the shares first, and sell them to you at a slightly higher price, pocketing the difference. It's called latency arbitrage. You never see it happening, but you pay for it every day. It's not illegal. It's just a reminder. You're playing a game with billion-dollar players who designed the rulebook and the racetrack. Final thoughts. The The game was never fair, but you can still play it smart. Here's the uncomfortable truth. The stock market isn't a level playing field. It's a chessboard of deception, and most retail traders are pawns. But being outmatched doesn't mean you're doomed. The first step is awareness. Once you understand how institutions manipulate narrative, volume, sentiment, and structure, you can start aligning with them instead of fighting them. Trade less emotionally. Wait for liquidity traps. Study volume instead of hype. You won't beat the machines, but you can stop feeding them. If this shocked you, and it should, hit that like button, subscribe, and turn on notifications. We're peeling back the curtain on how Wall Street really works, one video at a time. Drop a comment below. Which tactic surprised you the most? And which one should I break down in the next deep dive video? Whether it's dark pools, stop-loss hunting, algorithmic traps, or index front-running. You decide where we go next. Thank you for watching. Until next time.